Hello and welcome to Cafe Mutual YouTube channel. Friends, we all know that India is on a path to become the third largest economy of the world. To capture this growth, one has to remain invested across all sizes of companies, be it large cap, mid cap, and small cap. But mutual fund comes in different sizes. But what if I tell you that there is a fund that will invest in all sizes of companies in equal proportion? Yes, you heard it right. Nippon India has come out with Nippon India Nifty 500 equal weight index fund. So the fund will invest across top 500 companies of India in equal weight. So to discuss more about this opportunity, today we have invited Arun Sundaresan, head ETF Nippon India Mutual Fund. Arun has over 2 decades of experience in the mutual fund industry. So without wasting time, let's welcome Arun. Welcome to the show, Arun.
Thank you, Nishant. Thanks for having me on the show.
So Arun, before moving on to the fund, equal weight fund, we would first like to understand about smart beta strategies and why smart beta strategies is getting popular among investors and distributors.
Interesting to start with. I'm sure, Nishant, our investors and partners will be familiar with these terms, beta, alpha. I'll
Yeah.
come to smart beta very quickly, but let's start with that. See, beta is a term which is used to denote systematic risk. So
Hmm.
it's usually associated with stocks. Any stock could have systematic risk associated with it. For example, if it is a steel stock, right? Given the nature of the business, the company is expected to inherently have certain risk, right? So this is called as beta. That particular stock will have a certain risk, right? Measured as beta. Now, when you invest into a diversified set of stocks, you're
Hmm.
also investing into a steel company, you're investing in IT, you're investing in a FMCG company. The systematic risk is supposed to be diversified away. That is when you're investing in the market,
Hmm.
right? So the market is said to have a beta of one, which means that all systematic risks have been diversified away, right? So that's the concept of beta. Now, what exactly do you mean by market? In general, you will mean Sensex, Nifty, or you will say mid cap, Nifty 500. All these are diversified indices, generally called as market, right? This is number one. The second concept is alpha. So alpha is the excess return you try and generate by investing in a portfolio or a fund, right? That's what fund managers do. They attempt to generate alpha in addition to the market risk. You're trying to generate additional return, right? That's called as alpha. Now, in passive funds like ETFs and index fund, there is no concept of alpha, right?
Hmm.
So they are trying to replicate an index. So there is no concept of beating the index and generating alpha.
Hmm.
But what happens if the index itself is designed to possibly generate better returns than market and in certain market conditions,
Hmm.
right? Those kind of indices and funds based on those type of indices may be called as smart beta indices or smart beta funds. So, in a nutshell, what is alpha to an active fund is smart beta to index funds or ETFs. You're trying to get additional or extra returns than market. In a way, you're tweaking some aspects of the market composition and then trying to come out with a solution which can potentially perform better than markets at different points in time. So that's a concept of smart beta.
Okay. So you are coming with an NFO, a Nippon India Nifty 500 equal weight index fund. So can you explain about this fund and is it a first of its kind in the industry?
Yes. So we did speak about smart beta strategy. So one such smart beta strategy is equal weight way
Hmm.
of investing, right? There are other smart beta or factor, you call it by any name. Um, uh, these indices are already available. It can be value, it can be momentum, it can be alpha, it can be dividend opportunities, etc. Now, equal weight also is one such smart beta kind of investing, right? Now, what difference. So we talked about market, right? We said that it could be Nifty, it could be Nifty 500. So
Right.
in general, all these indices will be built, the weight of different stocks will be based on market capitalization. To be specific, it will be based on free float market capitalization, which in turn means that the bigger the stock is, the bigger a company is in terms of its size, in terms of its market capitalization or free float market capitalization, that will have a higher weight in the index, right? So one stock will have a very high weight, followed by the second biggest stock, third. That's how it will go. So invariably, all these broad market-based indices will be market cap-based, which will result in a phenomena where a few stocks will invariably contribute almost everything to the return as well as risk of the portfolio and the index, right? So this is the general approach to investing, which is the beta or the market approaching, right? Now, smart beta is a variation of this, where instead of using market cap, right, here we're going to make equal weight investing across all the stocks, right? So the fund that we're talking about, the new fund offer, Nippon India Nifty 500 Equal Weight Index, as the name itself suggests, it will invest in 500 stocks, that is Nifty 500 stocks. In all the stocks, it will invest approximately 0.2%, therefore, equally 0.2% in all 500 stocks. And that is a big difference to how probably a Nifty 500 is constituted, right? So now, what happens with this approach, right? Now, if you take Nifty 500, even though it gives an impression that you're investing in 500 stocks, the top 100 stocks, which are all large cap, the top 100 stocks are classified as large cap stocks. They account for almost 73% of the index, right? So essentially, you wanted to make a broad-based investing in 500 stocks, but you're investing almost 73% only in large cap, right? Now, contrast this if you instead do equal weight investing, which is what this fund would do, you're investing 0.2% in every stock, right? So the top 100 stocks will account for 20%, right? So again, 73% large cap of Nifty 500. Here, you're going to get only 20% in large cap, 30% in mid cap, and the remaining 50%, the last 250 stocks are considered to be small cap. So that 250 out of 500 is a 50%. So you get 50% exposure to small cap. So when you're investing in Nifty 500, you're getting 73% in large cap. Here you're getting 20%, and the remaining 80% is in mid and small cap. This is from a market cap, kind of a variation. At the same time, because of the contrast between market cap investing and equal weight, the way the different stocks contribute to your return and risk also is going to be different, right? It's not only large cap, mid cap, small cap exposure, but within that, again, all the companies here are going to contribute equally, vis-a-vis in a normal broad-based investing where a few stocks will dictate, your risk and return, right? So that is the big difference. This is for the first time. This is a unique proposition where on Nifty 500 there is a equal weight, but equal weight as a concept has been around. There are strategies on Nifty 50, Nifty 100, etc. But on Nifty 500, meaning on the entire market, large cap, mid cap, and small cap, a equal weight strategy is a unique offering. This is first of its kind in India.
Yeah. So this looks very, interesting. The proposition of fund is very unique. But how the fund has performed over the past, and can one expect it to outperform the broad-based market?
See, the index backtesting, the data is available since 2005. So we have almost 19 years of data. So historically, since that time, it has outperformed Nifty 500 by a reasonably good margin, right? While this is one time point to point for the last 19 years. Last 1 year, as of July 31, the last 1 year return of this strategy is 56%. During the same time, Nifty 500 has given 39%, right? So this is the last 1 year return. Of course, we have looked at calendar year return. I talked to you about 19 years, right? In 14 out of 19 years, this is given positive return. And on an average, it has generated 3.8% additional return over Nifty 5 on a calendar year basis. So this is how it has performed. Having said that, investors should also keep in mind that no particular strategy, no single strategy will outperform all the other strategies at all points in time, right? So there will be times when a particular strategy will outperform. There will also be times the same strategy could underperform. Now, this is a strategy where, given the past data, so we cannot obviously extrapolate. I'll not be able to comment whether it will outperform in the future, but based purely on the past data, a lot of times it has outperformed, especially during periods where when there is market optimism, when we say there is a broad-based market rally, when there is in general positivity around equity market performance. During those times, it has done well. In fact, the outperformance tends to be significant. On the other hand, during periods where in general there is little negativity about market, the market moves in a very narrow range, or we call it like market in a narrow zone. During those times, the strategy may, at least in the past, has underperformed as well. So this is a strategy where, if as investors or partners you think that, look, India, you started your conversation by saying we are on the verge of becoming the third largest economy. India is growing fast. So you think that Indian economy will do well. Consequently, the stock markets will do well. But at the same time, you're believing that not necessary that a few large stocks will lead this movement. Maybe many stocks have. So let me put my money across and spread my investments across a larger basket and let it work for me. I'm not very specific, or rather, I think that I should not invest only into some pockets of the market, or believe that only some large stocks will give me returns, the others may not. If you're of that kind of a belief, if you have that hypothesis about markets, I think this will be a good strategy for you to consider investing in.
Okay. So one last question, Arun. What type of investors should look at this fund?
So very clearly, any equity product, right, is meant for the longer term. It comes with high risk, high return potential, right? So this is again, equity product. That's point number one. The second point is, even within equity, if you would have realized by this time, this is going to have almost 80% exposure into small and mid cap, 20% into large cap. Right. So that makes it relatively more aggressive from that positioning, or given the constituents. Therefore, even within equity, investors should keep in mind that this has to be for even longer. And like I pointed out, that at least based on the past returns, the strategy seemed to have worked in phases where there is in general optimism bordering on bullishness, right? So to that extent, if your hypothesis, if your expectation about market is that markets are likely to do well, I do think that in general markets are likely to perform well. During those phases, this kind of strategy could potentially outperform. At the same time, investors should keep in mind that if market enters a slightly risk-averse scenario, where in general, equity markets underperform, within that, the strategy could, underperform even more, right? So having said all this, to conclude, this is a strategy where, because of the constraint, this is likely to be far more diversified than in general other market-based products, which give weights to larger stocks. To that extent, this is going to be very well diversified. The portfolio also is likely to be unique, because most of the other funds that they may have in their portfolios the exposures will revolve around the same set of stocks, in a little less, little more. As I said, even in Nifty 500, the top 100 stocks account for almost 73%. The top 20 stocks, just 20 stocks account for 43%. So invariably, you're going in and around, similar stocks in some proportion or the other, whereas here your exposure will be very, very different. But end of the day, this is a broad-based market investing, having a larger exposure to mid and small caps. So to that extent, I would describe this product as relatively high on risk and return potential. Therefore, investors seeking that kind of risk return profile should possibly consider this one.
So, all right. Thank you so much, Arun, for your valuable time and inputs.
Thank you, Nishant.
So it was very interesting session, and all the best for your NFO. And I hope that the diversification that the fund brings will help a lot of investors grow money.
Thank you very much.
Finally, I thank each one of you for being such a wonderful audience. Have a great day at work, guys. Bye.